Hello and welcome to this video on budget. So previously we've been looking at the finances of our business, and in an earlier video we looked at sales forecasting, in which businesses try and predict the level of sales in the future. Now budget is a similar concept to this, but the business doesn't just try and predict how many sales it's going to have in the future, it tries to set targets, financial targets for all the different areas within the business, and that's what we're going to look at today. So our objectives in this video are to answer the following questions. First of all, why do businesses prepare budgets? What is the difference between historical and zero-based budgeting? And then lastly, how can a business use their budgets to improve their performance? Now budgeting is probably a concept we're all familiar with. For example, every week I go to my local good value supermarket and I do my weekly shop. Here's my shopping list, and in my mind I'll prepare a budget, a kind of target amount of money which I expect to spend and I don't want to go over. So I would look at my list and say, this week my target, my budget is £15 to spend on my shopping, and I'd make sure I try not to go over that. And it's a similar concept for the business, and I'm really looking forward to that pizza later. So let's get started. A budget. What is a budget from a business's perspective? Budgets are forecasts or plans for the future finances of a business, and this is a definition we should take down in our notes. Normally they're shown in monetary terms, so a budget would be £10,000 to spend on supplies, but can also be in terms of number of units sold or other non-financial terms as well. Now there are three types of budget that we should be aware of that a business might prepare. The first one is an income budget. And an income budget is an agreed or planned income or amount of revenue a business expects to receive over a period of time. So it's sometimes described as a revenue budget or maybe even a sales budget. The second one is an expenditure budget, and this again is the agreed, planned, not income but expenditure costs of a business that they set as a target to not overspend over a period of time. So if you have an income budget and we have an expenditure budget, you can see where this is going. No surprises, the third one is a profit budget. And this is the agreed planned profit a business is targeting over a set period of time. So how might a business go about constructing a profit budget? Well, the first step is to analyse the market, really have a good understanding of the market in which the business is based. What are the prospects for the market? What is their likely market share? Is it growing? Is it shrinking? Exactly the same sort of things they were doing when they were forecasting sales. With that information, you can then draw up an accurate sales budget. So take your sales forecast, include any new products or any price changes that you're planning, and come up with a prediction or a target for the amount of revenue that you're expecting. Once you have a good sales budget, you can then draw up your cost budget. How much is it going to cost the business to generate the sales which you forecast? Again, take into account suppliers' prices, and most businesses will include a bit of a contingency. And a contingency here means kind of a bit of spare room or a little bit extra just in case the business might overspend slightly. And once you have the sales budget, subtract the cost budget and you get the profit budget. So here's an example of what a budget might look like for a business. This might be their plan or their target for a 3-month period. So in February, they're planning or targeting £6,000 in income. They're planning not to spend more than £3,500, and so their planned level of profit, their profit budget, is £2,500. Now there are two main approaches that we need to know about to budgeting. The first approach is called historical budgeting, in which we use previous year's figures as the basis for this year's budget. So for example, if 2 years ago our revenue was £10,000 and last year it was £12,000, then using that historical information you could predict perhaps that this year our budget for revenue might be £14,000, increasing by £2,000 each year. Now this advantage of this is it's realistic, but it might not reflect circumstances that might have changed. So what if a new product's been launched, or if there's been a recession, or if a new competitor has opened? That won't be reflected in our historical figures. So it's realistic, but may not take into account new circumstances. So historical budgeting We use the past to predict the future and use those predictions to make our budgets. The second approach is called zero-based budgeting. And in this example, or in this approach, all the budgets are set to zero and built up from scratch. So we don't look at what happened in the past. We think, what is our best estimate of what our budget should be? What are we expecting? What are we targeting for sales? What are we expecting? What are we targeting from costs? Now this is more complicated and time consuming because you really have to think about everything that's going on and take all the information into account. But potentially your answers will be more realistic because you are basing it on current information. You're not just looking at historical trends. So in this one, businesses or business departments think about exactly what are their costs and what are their sales likely to be. Then managers might put that information together to come up with budgets for their departments, and then they will convey this information, report this information to the senior management and say this is our target for this year, and the senior management will tell them yes, we agree that should be your budget, or there'll be some negotiation and they'll come up with what the final budget should be. So those are the two main approaches to budgeting. Now, why would a business set a budget? Why would you set a target? Why would I set a target for my supermarket shop each week? Well, lots of good reasons why. The first one is it establishes priorities, sets very clear targets. If you said to the business, right, our target this year is to sell as much as we can, well, what exactly does that mean? Some people would have some idea, some people would have a different idea. But if you say our target this year is to sell £10,000 worth, to have revenue of £10,000, that's a very clear target, a very clear priority that everyone can understand. So it turns your objectives into very practical reality. It provides our direction. This is our target, this is what we're working towards, and helps people achieve that. You can assign responsibilities. So most businesses will not just have one budget, that's one number. They may break it down into different areas. So a new product might have a certain revenue budget, your old existing product might have another revenue budget, and then it's very clear who's responsible for what and whether they've met their targets or not. It may also help you on the cost side allocate resources. And it will also allow you to communicate targets to your employees. It's very clear to understand that you shouldn't be overspending in this department if your expenditure budget is £5,000 and another department's budget is £7,000. It's very clear what your targets are within each department. It's a form of delegation. You give people responsibility. So here's your target. Go and have an income budget of £10,000, but you get that achieved however you like. So people might feel more kind of in control of their work. But ultimately you're still setting that target and you're still monitoring that performance, so you haven't lost control completely. Staff might find it motivating. Here's your target, go and get it. It's very clear and they can see how they're getting on against that target. And as a result, the business might work more efficiently. You can have a look at what you're expecting to achieve, which is useful, and you can monitor your performance against those expectations, against those targets, and take action if the performance isn't meeting your target. Ultimately, it allows you to try and control the income and expenditure, the revenue and costs of your business. Now, there may be some difficulties, as this man on the right hand side has experienced, with budgeting. First of all, it depends upon predictions and forecasts, and as we know, you cannot predict the future 100% accurately, so your budgets might not always be accurate, and that could be frustrating if you're not meeting your budgets. Some things change, costs might be changing, suppliers might want to renegotiate the cost they're charging you, and that would cause your budget to be inaccurate. Again, competitors, you just don't know what they're going to do. Some might close down, some might open new stores, some might bring out new products, and again, this would disrupt your budgeting. Now, budgeting, particularly zero-based budgeting, relies on managers to be able to put together budgets themselves, know their business, know what they're doing, and put it together. Now, if they lack experience further down the hierarchy, their budgets may not be very accurate. Also, there may be bias. There might be a temptation for workers to maybe set a slightly lower income budget that they think they can achieve and that will look good, maybe a slightly higher expenditure budget, so they've got a little bit more leeway on how much they spend, and so it might be slightly biased and not the best interest of the business. The last point there is it can take time and effort. which has an opportunity cost, all that time and effort building a budget, could it perhaps be better spent by just going out there and starting the business? Okay, so the next section we're going to look at is how can a business use budgets to monitor their performance? And we said that one of the main reasons why you set a budget is so you can monitor performance. And you can do that by comparing what actually happened to the budget. And any difference is known as a variance. So take this down in your notes, please. A variance is the difference between the budgeted amount and the actual amount. So if this is a profit budget, and this is what actually happened in terms of profit, the difference would be called the variance. So if our expenditure budget was £25,000 and we actually spent £27,000, we would have a variance of, you guessed it, £2,000. Now the business can analyse those variances, calculate the differences, and then try and interpret them. What can they learn from those differences to help the business perform better in future? So for example here, if the budget was £60,000 in terms of income and the actual income was £62,000, the variance would be £2,000, and so on and so on. So calculating these variances and thinking about these variances is an important role of the finance department. Now variances can be analysed as two types, adverse or favourable, and these are important definitions and concepts to get straight. So the first one is, what is an adverse variance? Well, an adverse variance is one that is kind of bad news for the business. Things haven't turned out as well as they might have hoped. So for example, if their expenditure is higher than budget, they've spent more than they planned, then this would be bad. If the income was lower than they planned, then this would also be bad. Profit was lower than planned, then that would be an adverse variance, i.e. not one the business would have desired. A favourable variance, on the other hand, if you think of the word favourable in your favour, it's kind of good news. A favourable variance is one that is good for the business. So for example, if they spent less than they planned, that sounds like a good thing. If the income was higher than they planned, that sounds like a good thing. If the profit was higher than they planned. It's important to remember that an adverse or favourable variance could be higher or lower. The key is to look at, is it expenditure, is it income, or is it profit? So for example, expenditure higher than budget is adverse, but income lower than budget is adverse. So don't look at whether it's higher or lower, ask yourself, is it good news or bad news? Let's have a look at some examples down here. The income budget that we had before was £60,000, and what actually happened, the income was £62,000, so that variance was £2,000, but it's good news, actual income was higher than was planned, so that would be favourable. Expenditure budget was £32,000, the business actually spent £30,800, again the variance is 800, it was higher, but this is adverse because the business spent more than they planned. So the profit overall was 1,200 higher than planned, so that would be favourable. So let's have a look at some examples here. Here we can see a business with two products, their revenue and their costs, their profit. In this column here we have their budget, their planned, and in this column here we have their actual, what actually happened, and the variance is simply the difference between the two. This final column is analysed whether those variances are adverse or favourable. So for example, the standard product sales are 15,000 higher than budget. So this is a positive or favourable variance. The actual wages were higher than budget as well, £3,000, but this is an adverse variance because this is not good news. The business has spent more than they planned. The last thing is the profit variance overall was positive, £3,000, so this would be favourable. It was better than planned. And that's adverse and favourable variances. So what might cause a variance? What might cause a difference between what's planned and what actually happened? Well, the competitors' actions might impact it, or maybe something to do with suppliers where they've changed their prices, or general changes in the economy, or maybe it's a problem internally. The team itself hasn't been very well motivated or hasn't been managed. So what should you do? maybe the internal decision making hasn't been quite right. So these might be some causes of variances. So this is a variance, and the business is analysed whether they're favourable or adverse. Then they need to decide what to do. The businesses need to decide how to respond. So they might consider a number of different things. Changing the budgets might be the simplest one. Maybe the budget just wasn't right. Maybe they need to train the staff better, or reward staff better, and motivate them. Maybe change suppliers, or reallocate their budgets to different departments. Or maybe they need to try a new marketing tactic to encourage more sales. Or maybe they need to review how many products they're offering. But the key is using the analysis. Can they identify where the problem is, and then think about what it is the business should do. So, in this video, we have looked at why do businesses prepare budgets. We've looked at the difference between historical and zero-based forecasting. And lastly, we've looked at what a business might do to improve their performance. They might use variance analysis and then use that analysis to inform future decision making.